Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today we welcome Jamie Coutts. He is a Bitcoin researcher. Jamie, welcome to the show.
Hey Nick, it's a pleasure to be on.
All right, Jamie's visiting with us from Sydney, Australia. Jamie, you have a thesis out there that Bitcoin is going to be adopted by nation states. We are in the process of that this year. Tell us about your thesis and specifically why you believe the United Arab Emirates are, in some ways, right now already in the process of allocating to Bitcoin.
Well, you've got several nation states now that are in the Bitcoin mining game. So you've got, and they're relatively small on a global scale, but I think the United Arab Emirates being one of them, you would argue is more of a mid-tier and a significant player in terms of energy importance. But you've got Oman, you've got United Arab Emirates, you've also got Bhutan. You've got countries in South America now, obviously adding in as well, El Salvador. I think it's either Paraguay or Uruguay that's potentially looking at it as well. The thesis sort of surrounds like you don't have to sort of, it's not a stretch of the imagination to consider that given the fact that we are most definitely now in a multipolar world, that you've got countries that are aligning themselves with the non-US bloc, or at least playing neutral or maybe both sides, that if they have domestic mining operations, which some of them now do, and some of them probably have not disclosed, that in these sort of countries, the separation between private and public entities is quite blurred, reasonably opaque. So the sovereign wealth funds, the pension funds in these countries, which are large, have large savings pools, are investing in their domestic mining operations. They've made Bitcoin mining, in the case of these Middle Eastern countries, they've made it a strategic imperative to actually be involved, whether it's to soak up excess energy or digitalize their economy, whatever the case may be. And so my thesis is just simply that if you're one of these countries and you're seeing sort of the long-term outlook, 5 years, 10 years, 20 years, you've got a neutral, non-sovereign, decentralized, inflationary hedge type asset, and you've got access to it through a domestic mining operation, and you do not have to buy it on exchange and reveal and go through that process of KYC, or even the nuisance of making sure that your coins have been KYC. Not that that's necessarily a good thing. I'm not arguing for the whole point of KYC, not at all. But in terms of their thinking, then I actually see the fact I see them, taking some of those coins in terms of the block reward that their domestic mining operations and holding it on their balance sheet. None of them have announced this, but I think it's something that we'll see towards the end of this year.
Get up to $100 worth of Bitcoin for free when you sign up with River at river.com/TBL. River is our Bitcoin exchange of choice, and we love River for two main reasons. Number one, they're Bitcoin only. That means there's no confusion when you go there. And number two, this is really important. River does not use a third-party custodian for Bitcoin storage. That means when you buy Bitcoin with River, that Bitcoin is being held in a multi-signature storage solution by River itself, not by any custodian that might default or lose your coins. Check them out today at river.com/TBL for that special offer. Now, Jamie, explain to us the last point you just made. Expand a little bit on why it is so important. Let's use UAE, for example, here. There is a marathon-led mining operation in the UAE now, and it is your thesis that the country, the nation state level involved in a domestic mining operation, even if it's contracted with an American publicly traded corporation, that in some way the block rewards, which are then not KYC coins, they're not being purchased on exchanges by the sovereign wealth funds trading desk. Why is that so important? And how does that play into why you believe the UAE is allocating to Bitcoin via this operation, and tie this all together for us? Why is it so important that they're not buying Bitcoin on exchanges and rather getting it this way?
It just removes a couple of steps from the process and also keeps their cards close to their chest. So rather than open an account with Coinbase, and obviously client confidentiality is paramount with all these institutions, but why bother? Firstly, we've got to understand whether they think Bitcoin is valuable, and that's very hard to gauge. Other than the fact that they have made Bitcoin mining a national imperative. So I think that it's just that it's adding those couple of clues together and coming up with a hypothesis at this stage. But why would you bother going to the market, or even if you take a very small position in the off chance that the world moves in a certain direction? By doing it through your domestic mining operations, you can keep it very clandestine, and not be exposed to having it revealed to the marketplace. And obviously, if you're very aggressive or very bullish on the asset, that's the most important thing, because you want to soak up as much of it at the best possible prices before anything hits the market about sort of nation states buying it. At this stage, it's a hypothesis, but I think the signs are there.
And I would argue that when you say that they are doing this because of the reason that, they don't have to start an account on Coinbase or whatnot, I would argue that the playing their cards close to their chest is 99% of the reason here that what you're describing is your hypothesis. Because the counter to your hypothesis, the counter argument would be that no, that's not taking place because eventually we will see the sovereign wealth fund purchase shares in the BlackRock ETF, disclose it in some quarterly or annual reporting, or that through the backdoor, we will get an understanding of the shareholders via BlackRock and the public disclosures that they have to give the market. That is the counter to your thesis. But if you are a nation state and you're declaring Bitcoin geopolitically important on a multi-decade time horizon, which route are you going to go? And I think, Jamie, that's the point here that we have to try to drive home when we're trying to think about whether the UAE is stacking sats as we speak, via the marathon or other associated projects, right? They could have marathon with a project, and they can have a contractor, perhaps marathon, we're speculating, or some other contractor build them a twin operation that is, like you said, clandestine, and in that way amassing Bitcoin in a non know your customer format. So what is your response there, Jamie?
Yeah, I think anything is possible. When you're at the end of the day at a nation state level, they look at this in a very different light to maybe a retail investor or another investment manager. Of course, BlackRock is one of the largest institutions, and I don't pretend to understand what happens at the very elite levels, but BlackRock has a very close relationship with nation states, some of the leading nation states. But at the end of the day, it's still a US based company. And as a nation state, you have your own national interests in mind. And therefore, you may seek alternatives to just going through the ETFs. Now, for some countries, that may not be the case. You may see them acquire the ETFs or acquire shares in the ETFs as a way to get exposure. But where you've got domestic mining operations, given that you've gone to that extent where you've invested capital, national capital, into the actual production of the asset, it just doesn't make sense that you would go through the ETFs when you have access to the primary source.
That's a good segue to talk about the ETFs now. We are recording this on Tuesday, March 5th. In the US, it's Wednesday morning for Jamie. On the 6th, we just saw Bitcoin hit an all-time high in today's session, then have a 10% or more pullback. typical bull market price action from Bitcoin, a lot of the price rise of the last month to 2 months is being attributed to these spot ETFs going live, supply coming off the market, tucked away into ETF managers' vaults. What is your opinion on the correlation between the recent 50% rally and the ETF vehicles being live and taking coins off of exchanges? And then who do you think is buying? And I know that that is much more a speculative question, because the holding reports that we do anticipate to get from both sides, the owners and the issuers, are still to come, for the most part. We don't have that data. So talk to us about your view on the ETFs, and then speculate for us that who is stacking right now.
Well, clearly these have been exceptionally successful products, in some days soaking up supply of the market at a ratio of sort of anywhere between 5 to 10 times the natural supply. So this is incredible in terms of the way that they've accumulated the amount of assets they have in a short period of time. So all in all, extremely bullish. Outlook is very positive. I expect the ETF demand to continue, irrespective of the gyrations in price. But to your point about what happened in the price action this morning, I made this point in January, and I made it again in the last week or so. I think everyone is getting, if you have a long-term basis, what I'm about to say doesn't make much difference, right? So you get these 10, 20%, even 30% pullbacks. They're to be expected in the bull markets, especially when you get 90% of the entire network sitting in a profit, like the compulsion to sell increases. But the area which I focus in on, that has been sort of a little bit ignored in the last couple of months, has been what's been happening in the derivatives market. I have a dashboard with all of my on-chain indicators, market indicators, and also derivatives. And everything was sort of screaming excessive positioning leading into this week. If you look at the funding rates, Nick, which is obviously, it's one of the best indicators out there, but when you get funding rates on an annualized basis exceed 50%, they got as high as 70% one day this week, you know that actually it only takes a small pullback to set off a liquidation cascade. And so we had that. It happened right at the all-time high, which is, from a technical standpoint, an obvious resistance level. So, look, I mean, for people that are stacking and that have a long-term thesis, which I certainly do, it doesn't really matter. But for those that are sort of in this market on a short-term basis, those that are trading, there was nothing about this market this week which suggested you should be buying. And the market will just do its thing. It will reset, that leverage gets wiped away, funding rates will hopefully come back to a more neutral position. And then, we start the game again. But underneath that, you've just got this structural buy from the ETFs, from RIAs and large institutions that are allocating 1, 2, 3, whatever their models are saying, that are becoming which are a little bit more price insensitive. But you and I both know, being technicians, like, prices do matter eventually. If you go up too fast, then, and by too much, there is a gravitational pull. And when there is leverage that's driving some of that appreciation in the price, then you've got to expect what happened today. And it may continue for a little while yet, but longer term, it doesn't change the outlook.
Now, talk about funding a little bit more for us. What exchanges are you looking at for funding? And talk to us a little bit about the nitty-gritty of your funding portion of your own trading dashboard.
So I just look at the aggregate or the composite of all the perpetual futures exchanges, and just look at the average or the mean funding rate across those. So you can, if you're a little bit more savvy, you could weight it by volume or weight it by open interest to get a slightly more accurate sort of picture of the marketplace. Binance used to be a large part of the perps market. That's now shifted a little bit to some of the other exchanges. The CME plays a larger role, which are not perpetual futures. So the dynamics are changing, but yeah, it's a pretty standard average approach across all those exchanges.
And talk to us, Jamie, about your background. You come from Bloomberg. What is the product that you built at Bloomberg? Talk about your designation, which you and I share, CMT, Chartered Market Technician. What is that? How did that play into your work at Bloomberg? And then tie it all together with what is it about price that drives you in your research approach, and did that drive you to Bitcoin at some point in earlier in your career?
Maybe I'll start on that point and then go back to the first question. So, you know, maybe price wasn't the first thing that triggered my interest in Bitcoin. It was the first time I saw it was 2013 around the Cyprus banking crisis, where the depositors were bailed in, and then I think a Zero Head article was talking about Bitcoin rallying, and I thought that was interesting. It took me such a long time to really understand the network, understand the asset, understand the technology. So for the first couple of years, I traded it because of price, because it was, you know, as a technician, you look for trends, you look for momentum, and you look for volatility. So crypto had all of that, Bitcoin being the original asset. So, but from those formative years, I didn't fully understand it. I still had this incorrect perception. It's either going a lot higher, it's going to zero. And even though I held that view, I didn't think about it through the correct risk lens, because if it is a zero, if it's a binary asset, zero or a lot, then you should maintain a position in it, which I didn't do originally. But it was in the bear market of 2018 and 19, which I think was the time when I became fully, you know, engulfed with the whole Bitcoin thesis and what it actually meant for the world, for society, financial markets. And so I was at Bloomberg at the time, and I became a thorn in the side of the company, banging the table to get data, to get products. And so I led the Asia Pacific sales and product strategy for Bitcoin before moving into Bloomberg Intelligence to start their research product. The irony here is, Nick, that I actually thought the way to create a product around Bitcoin and around blockchain assets was not to approach it purely from a technical sense, although that's like an absolutely critical part of my process, a part of the modeling, a part of the research that I do. But I was looking at the surveys back in 2020, and you know, what were the reasons why institutions were not owning Bitcoin or buying Bitcoin, and amongst those reasons, amongst all the other ones like regulations and whatnot, was that there was a lack of data, a lack of sort of fundamental anchoring. So I set about actually creating fundamental based models for Bitcoin, and that's obviously using this really rich data set of on-chain data that's now become extremely popular, has a lot of predictive power over longer timeframes, in my personal opinion. And I've built my own custom indicators, and you threaded that in. But ultimately, you know, at the moment we've got this new source of demand, which is skewing a lot of those fundamental metrics, and it's no different to equity markets, right? I mean, you can say that a particular sector is actually very expensive based on traditional multiples like price to earnings or book value. But ultimately, you've got to follow the price. And as long as you've got, you know, risk measures or risk parameters around that using price, using technical analysis, then some of those fundamentals don't actually matter for a period of time in the market. You know, I always say the technical analysis bridges the gap between what's happening with the price and the intrinsic value, which rarely align.
Now, Jamie, talk to me about the on-chain metrics that are part of your research suite right now. How are you approaching the blockchain data? We've discussed many times at our research publication, thebitcoinlayer.com/subscribe, for people to go sign up and follow along. We talk a lot about realized value and explain and hammer home how the array of UTXOs moving and the price at the time at which those coins moved is essentially the fundamental input to most on-chain analysis. as you're striking the price as coins are moving around the network. And as a corollary, we've talked about MVRV as a ratio to relate the market price to the realized price, and using that as a fundamental anchor in our approach. So, what about you? How are you approaching on-chain from the 30,000 foot view for people that maybe don't even understand what we have presented from our on-chain side of things?
Yeah, well, first thing is to say that I love the Bitcoin layer. I've been a subscriber, I think, originally from the start. So the work that you and Joe do is outstanding. As part of my morning read. In terms of the things that I use, MVRV has been a standout. MVRV Z score, because then that normalizes it, has been an outstanding metric for Bitcoin throughout the cycles. It continues to be so. I think this morning, looking at where it is today, it might be sort of around 2.8 on a 2.8 or thereabouts, but below sort of 3 standard deviations. You know, if you look at the MVRV Z score and you see the trend line from the very first cycle through the next two, you could potentially argue that, you know, an MVRV Z score of around 4 to 5 is where the market might find a top in this cycle. We'll have to wait and see. There's a totally different market structure to the last times. But in terms of the metrics that I focus in on, I thought about, you know, what drives network value. So Metcalfe's law, you know, the value of a network is proportional to the number of users and the number of interconnections of those users on the network. And so I started from a very first principles basis and thought about active addresses, transactions, transfer values as a way to explain network value, and found that some of those actually do have a very reasonable statistical relationship with price. And so if you can basically do the same thing as you do with MVRV, create normalized Z scores for those on-chain metrics, some of them work very well. NBT, you know, network value transactions, network value to active addresses. These are on-chain metrics that I use in my process, you know, mirrored with like the trend following price or technical analysis overlays as well. You know, I think some of the other metrics around fees and also hash rate. If I only had one metric to go by for Bitcoin, other than perhaps like realized price or realized value, it would be the hash rate, because Bitcoin benefits from this, you know, unique consensus mechanism where you've got actual real world fiat money being invested, capital being invested in order to keep the network secure. And so I didn't fully appreciate it in the first couple of years. I thought it was important, but really it was in 2022 when I saw the hash rate continue to explode higher into the bear market, just its unrelenting march higher, that I knew that actually this was really the North Star for the network. If the hash rate is continuing to increase, then you've got a very strong fundamental basis for the price to be higher in the future.
Talk about the hash rate philosophically from the behavioral finance standpoint, back to your own first principles. What was that light bulb moment? Talk about it a little bit more, because I think that the discovery of the value of the hash rate itself, or why the network has value, and when you boil it down, it is the collective number of hashes attempted that give it that value. Just philosophically talk to us about what you identify in hash rate that gives you that North Star feeling, because that is a tremendous moniker for what hash rate is.
Well, a lot of the on-chain metrics move with price. So if you start to see price and a metric deviate, then that's giving you some information. That's giving you some signal. And you know, I expected that in the third quarter of 2022, near market lows, that actually, you know, some of these miners who were under stress at that time, and there was actually, you know, forced liquidations, would have resulted in a substantial decrease in the hash rate, and that didn't occur. So what do we need for Bitcoin to succeed in the future, we need it to be secure and immutable, and all those properties that give Bitcoin its value. And that is that's really reliant on the mining industry, on the hash rate continuing to grow. And so for me in 2022, when I saw that, it obviously gave me an incredible amount of confidence in the network, but it also forced me to do a lot of work on energy markets and understanding sources of energy, because what was happening in that market was a function of not only the technology improving, but this insatiable thirst of the network for cheap, essentially free or near free energy, excess energy, and how that changed my whole perspective on the energy debate, on the energy market. So that's maybe a little bit of a tangent, but for me it was just that real world companies were investing fiat into a monetary network, which was the antithesis of fiat. So they saw higher rates of return, even though Bitcoin at that point had fallen 70%. That was a clear signal.
Now, it's your belief that not only will nation states be amassing Bitcoin via non-KYC domestic mining operations, that the retail investing public will be stacking Bitcoin via ETFs, but you also believe that ESG funds and capital that has ESG mandates, more broadly speaking, are another huge source of demand for Bitcoin going forward. Talk to us about the ESG side of your thesis, and then collectively, really, and feel free, Jamie. I hate to do it, but I'm going to have to ask you, what's the upside in this cycle, the next 12 to 24 months for Bitcoin's price, given a lot of these seemingly, bottomless pits of capital that are coming in?
Well, on the ESG side of things, you can see that the Bitcoin is bad for the environment argument crumbling before our very eyes. The data just does not support that argument whatsoever. In fact, it could actually be the most important technology from an energy perspective that we've seen. If the world is going to transition to this net zero world, personal feelings aside about the whole climate change argument, which I don't really want to get into too much, but suffice to say that I think a lot of it is flawed. But if the world is going to move in that direction, then the people proposing or pushing or advocating for this should desperately start to look at Bitcoin as a mechanism to achieve it, because it is very clear that Bitcoin mining achieves, it decarbonizes the grid. It helps bootstrap a lot of the renewable energy projects for, in my country here in Australia, we've seen a huge increase in renewable energy sources on the grid. It's tripled over the last 10 years, and so have our energy prices. So something's not right. And in countries where you have renewable energy, you can basically subsidize it with Bitcoin mining. And then you've obviously got situations where a lot of countries have excess energy and it's not being monetized. And so whether that's to monetize it in the private sector, or to monetize it so that you can subsidize energy costs or tariffs for the rest of your economy, for the citizens that are feeling the pressures of price inflation, is an absolute no-brainer. So when you start looking at not only that, but the fact that if methane is the biggest concern of the climate catastrophists, and the way it can be applied to capture methane through landfills, through flared gas, then you've got another reason why it should be considered an environmental or an ESG asset. If you look at the every single metric, Bitcoin relative to every other industry, it's the most green. It has the highest percentage of sustainable or renewable energy sources in the production of Bitcoin. It's now estimated around 53 or 54%. And I have to give a shout out to Daniel Batten for his open source research in this space, which was the foundational research and data that I used in my Bloomberg Intelligence report last year, which went viral, where I sort of pointed out what's happening in this space. So, as an ESG manager, you're climbing the wall of worry right now. You're looking at what's happening. You're looking at BlackRock being the issuer. BlackRock, this institution that has pushed ESG down the throats of everyone for the last 10 years, now endorsing it. I don't think there's too many barriers other than internal approvals, and these firms and these things take time to start a process of approval to invest in something like this. It really could take up to 12 months or maybe even longer. But there is a percentage of those trillions, estimated at around $30 trillion of sustainable investment funds, which are going to start allocating to either Bitcoin itself or Bitcoin mining operations who are skewered or focused on renewable energy as part of their energy mix, and even private venture capital type operations, which are looking at landfills and flare gas, which I know Daniel Batten is pioneering as well. So all of that, coming back to the ultimate question that always gets asked, like what's your price prediction? I did sort of just the usual non-scientific, back of the envelope. What does this cycle look like previous to last cycles? And I know that there is a view out there that this cycle will shatter all the other records in terms of the price moves, and we will get a change from the declining price gains of each cycle. Obviously, first cycle had extraordinary percentage gains, and it's moderated over time. I'm still in the moderation camp, but that still brings me to, if we do half the percentage return off the lows to the peak in this cycle than we did in the previous cycle, that still brings me to $170,000 this cycle.
Jamie Coutts, thank you so much for joining us today at the Bitcoin Layer. Please tell people where they can find your Bitcoin research.
Thanks, Nick. It was great to be here. And if everyone wants to follow me, I'm on Twitter, Jamie1Coutts, and I'm also at Real Vision. I'm the Chief Crypto Analyst there, and you can find me at Real Vision as well. So thanks again, Nick.
All right.
Appreciate it.
Thanks, Jamie, and we'll catch you guys next time. The Bitcoin Layer is proud to be sponsored by River. Go check them out at river.com/TBL for a special offer of up to $100 worth of Bitcoin for free. Now, River is an amazing Bitcoin-only exchange that offers Lightning Network withdrawals and deposits. They offer zero-fee recurring orders and a really cool new feature that allows you to text Bitcoin to your friends and family. Go check them out, river.com/TBL.